Well, the first month of 2023 is in the books, and despite the bombardment of seemingly bad news, stocks have clocked in some impressive stats. So what could possibly bring this upbeat action to a screeching halt? Saz has got a downer for us today.
Yeah, I'm just running through some stats here that come compliments of our friend Keith Lerner over at Truist. Really has been an amazing start to the year. First stat number one, and our full story on this now on our homepage, but Keith noting the 50 worst performing stocks of last year are up an average of 20.1% this year. The 50 best performing stocks from last year, meanwhile, are only up an average of 1.9%. Just, I think, also ties back to what we wrote in the morning brief earlier in the week. It is a bizarre time to be an investor. Just given stats like that is just pretty interesting. Number two, a lot of these stock gains have been driven by higher price to earnings multiples. Keith notes that earnings estimates for the S&P 500 have ticked down to 11-month low, but valuations look through the prism of price to earnings ratios about 18 times. That's at the high end of the range seen over the past decade of about 18 times to 18.5 times. So very interesting to see that as well. And then lastly here, Keith noting there's indiscriminate buying happening across the board. Remarkably, all 50 of last year's worst performing stocks are up this year. So just, again, the market's out of the gate very strong this year. Some zany, wacky moves, especially in the context of earnings season not necessarily going great for a lot of companies.
That's not unusual. Like every start to a year, you see some of the
every start to the year's up.
I mean, I don't know if it's quite as universal, but I think that happens. Like, I feel like that happens at the beginning of most years, is that you see a flip at some of the narrative from the last year. I don't know. Maybe I'm just relying too much on my own faulty memory, which, you know, admittedly, it's not the best source.
It's just the magnitude. To see the 50 worst performing stocks last year, I imagine those are companies that have been fundamentally damaged, or even, of course, some tech names, too, looped in with a lot of these layoffs. But a 20.1% gain is just is mind-blowing. And to this point, you know, not to rain on anyone's parade here, you know, the fun time and the take is the fun times could be crushed by the Fed. You know, obviously, all these moves, to Keith's point, have been very speculative here. I think based in large part that we do get that pivot in rates, maybe some rate cuts later this year, but the Fed could really, I think, crush a lot of these folks out of these stocks very, very soon, and it could happen this week.
We'd never like to see the sad Saz graphic there on the screen.
Oh, I didn't even notice that. That was good. Oh, that was cool.
Yeah.
I like that. Yeah. I don't like being sad. I want to be happy.
Everybody wants to be happy.
Yeah.
All right, well, let's stay happy here for a hot second here. I think with our, actually, no, it's not with this story.